Hello everyone! Today let's speak about divergence and convergence in bond markets. And first of all, let's realize that we are about to experience a very rare situation in monetary policy, as the European Central Bank, the ECB, could cut its benchmark rate before the US Federal Reserve, the Fed. And this would be the first time since the early 2000s. At the start of this year, 2024, the market was expecting the ECB to cut rates slightly more than the Fed. Expectations were for 6 cuts in the US and between 6 and 7 in Europe. So as we approach the middle of the year, where do we stand? Neither country has yet cut its benchmark rate, and among the G10 countries, Switzerland was the first to begin a cycle of monetary easing. In Europe, the market is clearly expecting a rate cut in June. But the picture for the US is less clear. While some expect a cut in July, the implied probabilities in future contracts do not point to a cut before November, and this may be followed by a second cut in December with a probability of 50%. So this means that Europe could cut rates further and faster than the US in 2024. One of the cruxes of this difference lies in inflation and the perception of its evolution. While the ECB says it's really confident that inflation is under control, the story is different for the Fed. Since the inflation figures for April published mid-May that came in slightly below expectation, the Fed has been tempering market expectations about the timing and the scale of rate cuts. A plethora of central bankers are speaking on the subject, and they have one common thread. It will take more than one single piece of data to ensure that inflation is under control and that the monetary cutting cycle can then begin later this year or even early next year. In other words, volatility is the order of the day, and bond yields are swinging regularly, like the 10-year US yield. It started the year at 389, climbed to 470 at the end of April, and is currently at 443. And although expectations are different, the performance of government bond market is similar. Minus 1.5 in the US, minus 1.4 in Europe. And in Europe, disparities are considerable. Minus 257 in Germany compared with plus 0.6 in Italy, which has benefited from a tightening of its risk premium. And Switzerland, well, the bond market is doing less badly, but remains in negative territory at minus 0.9%. So between the central banks that have already cut their rates, like Switzerland, those who are preparing to do so, like Europe, and those that are stalling, like the US, it is interesting to note that their bond markets are steering their course without fully incorporating expectations of rate cuts. And close to their highs of the recent years, bond yields still offer a good entry opportunity for investors who have not yet taken the plunge and bought bonds. Thank you.